screen here. Good evening, everyone. Thank you very much for joining us tonight in the Repatriating Financial Planning Masterclass.
Hi, everyone. My name is Annie Meikle, and I'm going to be assisting moderating the session tonight. As Basim mentioned, tonight's session is Repatriating Financial Planning Masterclass, From Expat to Homecoming, a Cross-Border Planning Guide. We're going to run through some slides, and of course, we have a few speakers tonight. We are going to have a Q&A session at the end of the entire session. So if you can hold your questions till then, or if you feel like you'll forget, just drop them into the chat and then we can go over them at the end. So I don't want to keep you all waiting. I'll just go ahead and start introducing the speakers for tonight. So let me start by introducing Basim Fauzi. Basim is an accredited Canadian financial planner holding a law degree, LLB, PFP, and fellow Canadian Securities Institute. He has nearly 30 years of experience, including senior roles with BMO and RBC in Canada. Today, he serves as Vice President for MENA at Elixir Wealth Private in the DIFC and is also the Connect Finance Group head at the Canadian Business Council here in Dubai. He specializes in helping Canadian expats with retirement, estate, and repatriation planning, and guiding families through every stage of their financial journey. We also have our guest expert for the evening, Wayne Buick. Wayne is a CPA, CA, CFP, and also a US CPA. He is the managing partner at Trowbridge Professional Corporation and brings over 25 years of experience in international tax and cross-border structuring. Wayne is widely recognized for his expertise in Canadian residency rules, offshore trusts, and investment taxation, and he has advised Canadian expats all over the world. Together, Basim and Wayne, and also Santosh, who we'll introduce in a moment, will walk us through the financial, legal, and tax considerations of repatriating to Canada and how to plan proactively for a smooth transition. So I'll let Wayne introduce Santosh.
Yeah, so Sant, I've seen a lot of things, but I'm not the best with the corporate tax, especially with offshore. So Santosh Prasad, who is a director in our international tax group, has been kind enough to help me out here. So Santosh probably has 25 years experience. He's a CPA, and he's been with us for quite a few years now. So thanks again, Santosh, for joining us. So.
No problem. Nice to be on, and yeah, you called me out. I'm old. Yes, I do have 25 years of experience in tax. So.
Yeah.
Thank you for joining us, Santosh.
Yeah.
Yeah.
Thank you. All right, so I'm gonna dive into our evening talk. I'm gonna say it's a talk because it's a topic of financial planning. It's a big topic, and we can't really say exactly the components of what is the financial planning and why all that. So we decided that we're gonna have this as a discussion. There are main points that we'll go through, and Wayne and I will dive into other topics. But to start off, why I'm doing what I'm doing. So some of you, and I see some familiar names on the registers list, that they have been following our webinar over the last year or so. So I've been asked, like, why you're doing what you're doing. Basically, having the financial planning series for Canadian expats. Well, number one, it's being a financial planner and wealth advisor or a wealth manager is not exactly a job. It's a lifestyle, and it's something that become part of you as you grow deeper and bigger in what you do. But this is my second rodeo here in Dubai. So my first rodeo, I went back to Canada in 2011. And while I was born and bred in the financial system, of the Canadian financial system and the legal and tax system, when I went back, I felt like I'm a new person. I didn't know a lot of things. I was confused. It took me some time. Oh, and by the way, so I forgot to tell you. And when I went back, I went back working for BMO. So I left BMO and they brought me back. So everything is the same, but nothing is the same. So that was the first slap in the face. And like, I'm like, you don't think you know it all. It took me some time to figure it out. Long story short. But in my tenure working, between 2011 and 2023 for those 12 years, I've been receiving a lot of expats coming from Dubai or UAE in general, Middle East, Saudi Arabia. And I've seen them coming in with certain expectations, and some were quite disappointing. And one comes to mind, and this was a pivotal moment in my career and how I'm looking at situation and client advice. Someone, there's a substantial amount of money at the bank, and, he came in, now he's retired, he's done, and he believes that's it. We're retiring, end of the story. And as we dug deeper into the situation and the family situation, unfortunately, that was not the case. But it's not the scare tactic that drove me to work on education and financial literacy. And I do financial literacy for us as Canadian expats as much as I do it for schools. So I've been called upon at some schools to come and talk to the children. So financial education is a big part of me. But let's jump into what are we doing today. So why financial planner matters. Sorry. So financial planning for Canadian expats, and for the purpose of this particular webinar, we're talking about us going back home, right? Not all of us can go back to Canada. Some of us will go to live in some other countries in Europe, or maybe back to their home countries, wherever they originally come from. Regardless, our tenure in the UAE is limited somehow, at least for most of us, not all of us, but just most of us. So returning home is more than a change of address. So you're changing from the UAE to Canada. There is more than that. It is a life event. The income and the savings and investments, they need to be aligned so you can carry through, or it carries you through to your next chapter. And that chapter is going back home. The structure, whatever it is that we're building here, whether our investments, our everything that we have, it's called offshore because it's not in Canada, so it's an offshore. Whatever you build offshore, is it working for you when you go back, whenever you go back? So today is all about structuring and planning and how structuring fit in your overall financial plan. And the message here that you're going to hear me and Wayne and Santosh and everybody here and Annie talking about, we're always saying you need to be proactive rather than being reactive. I've seen, again, from the receiving side, I've seen the reactive already. Like let me not go there. Let me just stay where we are. So moving forward, when we go back home, or when we go through the next step of the next chapter of our life, and especially let's say you're going back to Canada or anywhere else for that matter, but let's call it Canada for the purpose of this webinar. When you travel, you pack your bags and you go, most of us again, we go with three things on top of mind. The income, basically how I'm going to support the next chapter of my life. And if we have children education, and home. So those are the top three things. So whatever it is that most of us will be thinking when we're going, those are the things. Where am I going to live? How about my work? Am I going to manage my business from there? I'm going to have a business. So basically, the income, it's an important part of life. And children education. Once we settle, work is there, income is there, family is there, everything is fine, then other things start emerging. Then you start now you start feeling the pinch of taxes because you're working, you have income. Your income might be driven from your employment in Canada. Your income can be driven from your offshore investment. Maybe you brought in all your money in Canada. Now you're drawing income from that. Now you're seeing the pinch of the taxes. That now you see that, now you start understanding the risk on different portfolios. Then, wealth is good. Now we start thinking, we're getting ahead in life, and we start thinking retirement planning. Then we start thinking estate planning. It's all good and all. We're all going to go through this, but those things that is always good to do it earlier on than once we get in there. So that is the iceberg. Then, and I will refer to this method a number of times through our discussion today. So always remember, this is what will happen. You have the iceberg. Oops, what happened here? Okay. So the reality for Canadian expats, when we left Canada, most of us were in high income bracket, and we all felt the big pinch or punch of taxes. So we came here, we made the same, even more money, but this time it's tax free. And this is all good and all. So this is called the lifestyle inflation, where now our lifestyle is fitting what we have. Then, it's all good and we saved enough money that will take us on to the next part of life. You get there, then you start feeling the taxes again. Now the income is not the same. The tax get a little bit annoying, and then the planning again, proactive versus reactive is the part that we go back talk about it again. And from here, now we're talking about the planning. Now I'm going to turn this over to Wayne. Annie?
Yep. Actually, Basim, I'm just gonna share. I think we wanted to have this up. Just a minute here. Let me just share this. Okay. Is that the correct slide, or did you? Yeah, it's here,
Yeah,
right?
this is the slide. Yeah.
Okay, great.
Sorry, which slide is happening now? Mine or yours?
I've just shared it. Yeah.
Oh, okay. Go
Yeah.
ahead.
Yeah, this one's fine.
Mhm.
All right. Thanks, Annie, and thanks, Bassem, for having me. One other thing about me is I first presented in Kuwait in 2006 and Dubai in 2007. And I presented in person every year except one year during COVID. So I do have a lot of experience helping people in the region. Uh, it's interesting when you only actually go once or maybe twice a year to Dubai because the changes that happen in the city are wild. So, but yeah, I just wanted to mention I have a lot of experience there. So I think one of the key things here that Basman was talking about is really making sure you're thinking ahead because a simple slip up can be quite costly, right? And I've seen it a bunch of times where someone returns to Canada and they get a bonus. Well, the bonus is received while they're in Canada, and as soon as you move back, you're taxed on your worldwide income. So that makes it taxable in Canada, and you're paying tax when you don't really need to, right? So planning ahead for all these sort of things is incredibly important. So, you want to go maybe to the next slide? I've seen it so many times as a Canadian resident, you're taxed on your worldwide income. And for people that have been outside of Canada for a while and not paying tax, it's hard to get back and paying, the top rate in Ontario at 220,000 or 250,000, give or take, is like 53.5%, right? So when you're paying zero tax, and you're going to go to that, people aren't very happy about it, right? So what we do is, you look at a lot of different structures to try to minimize the tax, right? But what we typically try to do is actually start by potentially keeping it simple. And because people really sometimes they like talking about non-resident trusts or corporations or things like that. And sometimes you don't need to necessarily get into that detail of complexity, right? Maybe you just, move your assets around between different family members, and that could lower your overall tax, right? Um, um, but some things people like to talk about are non-resident trusts. The one thing, and I was talking to Basson about this,
Yes.
is that
Don't try this at home.
Canada wants to tax you on everything. So
Mhm.
if you think you have a great idea to not pay tax, someone else has thought about it, and the CRA has tried to come up with a rule to make sure that you're going to pay tax, right? And this really even comes down to non-resident trusts, right? So, people think, okay, I'm going to set up a trust while I'm a non-resident, and then it's going to be not taxable, right? But what ends up happening is, if there's a beneficiary that's a resident of Canada, right? And they're connected to someone who made a contribution, then that trust becomes a deemed resident trust. So setting up trusts to not hide assets, but to minimize tax is incredibly hard and complex. It's something we will look at, right? To make sure, does it fit your situation? But typically, it's a harder thing to make work, because of just the facts and the way Canada wants to tax everything. The one thing that still does work well, and again, you have to fit the situation, is something called a granny trust. Now, you don't have to be a granny to take benefit of this. It's just in the old days, typically the grandmother was the last person to pass away. And so if she moved the income into a trust, it would be tax beneficial. And so I'll give you an example. So say you inherit, $2 million from someone who's not in Canada, right? There's no tax on that inheritance, right? But if the money is then in Canada and you earn, 6% return, there's $120,000 of income per year that Canada is going to want to tax. Now, if instead the will directs the money into a foreign trust, you can then receive the payment in the next year tax-free. So in that instance, it could save you, 50 or 60,000. Now, again, you have to have a wealthy relative or someone that's not going to come to Canada for this to work. But if you do have parents that are overseas, or you're going to inherit for, brothers or sisters or anything like that, you want to think about the granny trust option. So, Santosh, we want to talk about offshore corporations, I think both from an investment perspective and then for people that are working. And I think if we can talk about it for someone who might only be in Canada for 4 to 5 years, and then maybe someone who's going to be permanently in Canada, to let them know, because people like using offshore corporations as well. So.
Right. All right. Wayne, thank you for the introduction. Bassam and Annie, thank you for having me. I'm a director in Canadian corporate tax, and we do a lot of inbound and outbound work. So the Canadian tax system is, applies or taxes corporations on their worldwide income if they are resident of Canada for tax purposes. So there's two ways a company can be resident in Canada in Canadian income tax purposes. One, it's incorporated in Canada, either you have a federal corporation, or you incorporate a company in one of the provinces. So automatically, if you're incorporated here, under the Income Tax Act, you are considered a resident of Canada, and whatever income the company earns will be subject to tax here in Canada. The other alternative, and because Canada is a common law country, we look at cases, we look at precedents in the United Kingdom, we consider a concept called central management and control, or often referred to as mind and management. So if the company's mind and management is in Canada, regardless of where it's incorporated, okay? So you could have a Cayman company, a BVI company, a UAE company. If it is managed out of Canada, so the mind and management is here, the director, if you're the shareholder, you're a director, and you're some kind of an officer, and you're actually doing some of the work here, the CRA would consider that entity, even if it is legally registered in a foreign jurisdiction, it would be viewed as having its mind and management in Canada. And so whatever income it earns, so it could be a Cayman company, it could be a BVI company, it could be a UAE company, whatever, it would be subject to Canadian tax if its mind and management were here in Canada. So, if you do have an offshore corporation, and the one way to avoid Canadian tax is to actually not do any work, or somebody else in the UAE does the work. And what I mean is, you have the offices are there in Dubai or Abu Dhabi, they're meeting with clients or generating business, doing sales, and you're just living in Canada doing absolutely nothing in relation to the company's, the underlying activities of that company. So, if you are the principal shareholder, owner, manager, and you are the intellectual property and the vision behind the company, it's your company, and you happen to be here and doing all of it, it'll be hard to prove or demonstrate otherwise that it is not being handled out of Canada. You can still be a shareholder of that company, you just can't do any work associated with that, because the company itself should have enough substance, it should have enough ability to function in another jurisdiction to actually demonstrate that it is truly offshore. And offshore from a Canadian perspective means outside of Canada. So anytime you might see non-resident trust or whatever, well, it's a non-resident of Canada, or an offshore means outside of the Canadian water, Canadian territory, whether it's land or somewhere in the ocean. That's part of the Canadian territory. And so, which brings us to what types of companies and how are they taxed? So, do you have an active business in that offshore company, or is it a passive entity that just has a portfolio of investments? Okay. An active business of some kind, it could be manufacturing, it could be sales, it could be professional services, consulting, anything that, any kind of intellectual business that otherwise just has an office and you're dealing with clients remotely. But there has to be real people doing some real work. Okay. You're providing goods or you're providing services or some combination thereof. Okay. In contrast, an investment business is a little more passive. You have a portfolio. To borrow on Wayne's example, you receive $2 million, let's call it $2 million US dollars, and you put into a company, and you hire a wealth manager. You hire Bassem to help you manage that money in Dubai. That is considered passive income from your perspective, because you're not really doing anything other than getting some kind of a dividend potentially. Okay. So, if you are not doing any work, it's considered passive. Usually portfolio, once you hire a portfolio manager to help you invest that money, and you're receiving an ROI on that of some kind, and again, that 120,000, you're earning 6% on the 2 million. That is passive. You're not really lifting a finger to get that. Okay. How Canada taxes those two situations is different. So if you are a shareholder in Canada, and you're the shareholder of this company, and you are living in Canada, okay, and that company were to have investments offshore, okay, we have rules similar to the United States. The United States has something called Subpart F rules. You may or may not have heard this, and basically any kind of passive income, even if you don't receive it as a dividend, it's still subject to tax in your hands as if you earned it. So we call it FAPI, foreign accrual property income. So if you have an offshore company that earns, and you're the shareholder of that company, and even if it's its mine and management isn't in UAE or wherever, if it is earning FAPI income and you're the controlling shareholder of that company, you're going to pick up your share of that investment income, even if you don't receive a penny. And this goes back to Wayne's earlier point. Canada's found a way to try and tax everything. And what they're trying to do is prevent sort of the Canadian tax base from being eroded by using foreign structures. And so that portfolio may not attract any tax in the UAE. That's a UAE question. However, you have to pretend that you receive that. You have to, and then you have to kind of pick up that notional 120,000 US, which I don't know, like it could be like 160 or whatever Canadian. You'd report that on your Canadian tax return for the year and say, I earned notionally 160,000, and you'll end up paying tax on that at your marginal rate. The other alternative is if you are conducting a business, and it could be a manufacturing business, it could be any kind of a service business, a technical business, consulting, and it is conducting, and it has a business. If it's managed in the UAE, and you can demonstrate that it's managed in the UAE, and there's no mine and management in Canada, it wouldn't be subject to tax in Canada. However, if you do have an offshore company and you are managing it out of Canada, it'll be subject to tax in Canada. In Ontario, the rate is 26.5% federal, 15, plus provincial of 11.5, so you're looking at 26.5% tax rate on that income, because if you recall earlier, if it's not incorporated in Canada, but the company's mind and management is here in Canada. And so the corporation would file a Canadian tax return. It would declare all of its income. It's a business income. It'll pay tax at general corporate rates at 26.5%. Because it is an active business income, as an individual of Canada, you don't pay any further tax on that, provided you do not receive a dividend from that. Okay. And what I mean is that the company on $100,000 of income, it would pay $26,500 in tax, leaving you with $73,500 after tax within the corporation. If that company doesn't pay you a dividend, that just remains in the company while you're a resident in Canada. So unless you actually declare that and put that on your personal return from active business, you don't pay tax on that. So your tax rate went down from 53.5 individually if you're in the top rate, down to 26.5. Okay, so you could use that company as a vehicle. Even if you're managing it in Canada, there is still a bit of a tax saving. Now, with respect to whether it makes sense to incorporate or not, it depends on how long you plan on staying in Canada. So if you, I think Wayne alluded to this, if you're in Canada for less than 5 years, and I think in a 10-year period, so you come to Canada, you're going to stay for about 4 years, and you had these assets, you own these companies before setting foot in Canada, whatever increase in value that may accrue in those companies while you're a resident will not be taxed on exit. Canada has this notional exit tax, which basically says you are deemed to dispose of your assets at fair market value upon exiting Canada and ceasing residency, which is a factual exercise. But let's say you move out and you've sold your house, or you've broken your canceled the lease, and you pack your bags and leave. You're deemed to dispose of that, again, a notional kind of example, on exit. However, if you've just come to Canada and you've been here for less than 5 years, you avoid, and these relate to assets that you owned before coming, you avoid having those deemed disposition rules impact you. So how that works and how does that apply to an offshore? If that offshore company, even if it had a lot of passive investments, and maybe those passive investments aren't really generating much in portfolio, they could be growth stocks, for example, that have little or no dividend. Any growth that accrues, you could use that and defer it without upon exit. So you even really, so if you bought shares of a new startup for $100, it's now worth $1 million. That that $1 million or 999,000 and change gain would not be subject to tax in Canada. Alternatively, when you look at the active business example, when the income is accruing in it, so if you keep that $73,500 in after-tax income in that company, there is no exit tax on the value of the company just because you've been here for less than 5 years. So it's a way to avoid paying additional further Canadian tax if you are going to be here for a short time. So it all depends on your particular fact pattern, what so whether on the underlying investments or on what your goals are. You're going to be here just for a short period of time. You want to get your citizenship or whatever, or you're going to be here for for quite some time. If you are here for a longer period of time, then you can still use the company. I guess in that case, if you do have an active business, you'd probably want to have a Canadian holding company if you're going to be here for a longer period of time, because any dividend that you get from a foreign company is ordinary income. There is no dividend tax credit or any kind of mechanism. Dividend tax credit is in some jurisdictions you call them franking credits. I think in Australia or the UK, and a dividend tax credit is a similar mechanism to avoid double taxation. But a dividend from a foreign company is just treated as ordinary income. There is no deferral that you get. So in those situations, you would probably have you'd probably want to use a Canadian company, because that actually between you and the foreign company in order to recharacterize some of that income to be an eligible dividend, which is a little more technical than what we need to get into, but there are some planning opportunities that you can undertake if you are going to be here for a longer period of time. So,
And so thanks for that, Santosh.
yeah.
And I think this kind of goes to show that sometimes planning can also be a little hard because people are not sure. You know, your kids are in university for 4 years, so you might only be back in Canada for 4 years, you might stay. So, um, you know, it's sometimes you plan for the best and things change. And I've seen it a lot of times where, you know, people have been outside for Canada and they come back and they get like the reverse culture shock and they can't handle the Canadian winters, just like Montreal, and they last like 2 or 3 years and and go back. So you know these are things you want to look at, you know, to see whether it works. So so those are great examples. Thanks, Santosh. I appreciate that.
Thank you, Santosh. Thank you
So
very
I'll
much.
quickly talk about portfolio bonds, wrappers,
Well, I think your time. This is good. Keep going, please.
yeah, yeah. Yeah. So I'll just quickly talk about the portfolio bonds and the private placed life insurance and it's good. What I love about working with Boston is he sent me something yesterday. I typically don't like these for Canadians because I don't find they're tax effective, right? And someone had given him or told him about a ruling where it was accepted, and we were both kind of like, I don't know, I don't see it. Canada just doesn't like these type of investments, right? So, you know, I
But it's not
typically,
exempt anyway. So that's the
yeah.
PPL is not exempt. Yeah.
Yeah, so
So
I typically don't recommend these for people, but they are sold a lot out there. So just something to be aware of, because if you're back in Canada, that they're going to want to tax the accrued income every year, which is probably the worst thing you could have. So each one is a little bit different, but typically I'd avoid those. So I don't know if you want to talk about them, Bassam, at all, if you have any personal thoughts or anything, or.
well, the same thing, yeah, with like starting off with the PPLI. It is like for those of us who don't know the PPLI, it's a private placed life insurance. It's an insurance wrapper. It works in a lot of jurisdictions. Uh, to Wayne's point, I examined it, I studied, and I just could not make much sense out of it. And the idea of those webinars that we put everything in front of you, right? Because there are a lot of people here, they just want to sell something and will make it look good. But yeah, to Wayne's point, I don't see this, right?
Mhm.
And especially it's not an exempt, like as Wayne said to me earlier in a private conversation. Some things set up in Canada, they get the exemption status, can be used, but then again, you know, a lot of rules that you have to follow. But those ones that commonly available here in this part of the world, chances are won't work because as we see that tax planning is really is a heavy duty business and everybody, you know, on that business, they do the heavy lifting of finding out what works and what doesn't work. Similarly, going to the portfolio bond, again, it's another insurance wrapper. You may or may not have it in your portfolio. It's a fantastic product while you are here. Maybe you would go your next, you know, the next country of residence might be the UK, which it works good with the system over there. But then again, if you're going back to Canada, what we're saying here is we're not saying do or don't. Please, thank God this webinar is recorded. Please do not take anything being said here as an advice, be it legal advice, investment advice, or financial advice. All right, we're just discussing the different aspects and different things out there. But when it comes down to it, please reach out to us and we'll be able to tell you what works and what doesn't work and how it should work. But I have a question, Wayne. I'm going to back to Wayne and Santosh. So now we talked about structures, right? Okay, if I'm receiving my income in Canada, now I moved to Canada, and my income is mainly driven from interest-bearing instrument, be it a GIC or you know the similar of a GIC here or a bond. Is an interest-paying instrument. Would I pay the same tax as if I bought some Apple stocks and I made money on them, or it's all the same?
No, so there's different tax rates on different things. So interest income in Canada is taxed at your at normal rate. So if you made 100,000 salary and you had 10,000 of interest income, you'd have 110,000 of taxable income. Capital gains are only taxed at 50% of the gain. So if you had, a $10,000 gain in Apple stock, only five of that would be taxable. So instead of having 110,000 of taxable income, you have 105,000. So to a certain extent, sometimes capital gains are better than interest income. Obviously, you're taking risk, but yeah, capital gains are typically tax preferential.
So it's more tax efficient income coming from capital gain. Well, of course, depending on the risk tolerance of the client, but in general, this is how it is taxed in Canada. So every income is taxed differently, and at the end of the day, it's all added up and being, take you up to the marginal, rate, depending where you are.
And this is why it's important to plan before you go back. Like as Santosh mentioned, if you're only back for 4 years, there's no deemed sale on the way out, right? And so I'll give you an example. You bought Apple stock for $100 on the day before you go to Canada, right? And it's worth $200 when you leave, right? Because you left within 5 years and you owned it before you came, there's no tax. Conversely, if you buy that stock the day after you're back in Canada and it goes up, that $100 is taxable. So to the extent you can get your portfolio ready in case, you only stay 4 or 5 years, it's incredibly important. And that's part of the pre-planning that you want to look at. So
Thanks, man. Yeah, this is the idea about us being here tonight is all about the pre-planning. And also we show Annie, which screen is running right now, mine or yours? Or you can just take
Mine
me to
is
the
running.
next.
Yeah.
Just take me to the next screen, it's fine.
Okay.
Yeah, thank you. Yeah, so that will bring me to, the pieces of the puzzle of that financial plan. So you have your tax planning, you have the legal side of it. On our level can be the estate planning, and we addressed this in my previous webinar, the cross-border estate planning, where we had Canadian estate lawyers and the UAE estate lawyers to manage your cross-border wealth. Like Wayne mentioned earlier, you can set up the most beautiful trust in the world and the most wonderful, airtight, but you have someone who just happened to become Canadian resident, and the whole thing become tainted and things go ugly. From the investment structure, and your lifestyle goal. So those pieces we were put together for your financial well-being. And okay, I'm just going to pass the next one. So this is just a quick example, between family that already planned and family did not plan. So when we back to the iceberg, when you stick to the tip of the iceberg, it costs on the long run. Like, as we heard from Santosh, as we heard from Wayne, things need some work and the planning is different. Like, like Wayne said, you buy an Apple stock one day before you become a resident versus one day after you become a resident. 4 years later, you're leaving Canada. Here you have big tax bill. The other side, you don't. So that's the asset allocation part. The other family planned it and they did not really react to anything because they knew where they're heading. So finally, why do we create a financial plan? I guess we don't have to say much. A lot has been said over the last 45 minutes. It reveals your end game and it shows where you're going. And it moves you from being reactive to from reactive to proactive. And it protects the family wealth cross borders.
I don't know,
Okay,
Asim, if I can say one thing about this, sorry,
please. Yeah.
I get people all the time that call me, they're like, I'm coming back in 3 weeks, and we do what we can, right? But there's this, when I do a lot of presentations, I actually have a slide that says peace of mind. There's a lot of peace of mind as well when you start planning early and you start thinking about it. So that's just an important part of this also, just so you know you don't have to worry about it. You're not rushing around at the last minute before you move back. So that's sort of something I've seen, I guess.
Well, Wayne, I second what you're saying, and actually, this is something I wrote down. Why I started this particular webinar that we have here today, the cross-border planning for that part, is because I've been seeing and meeting Canadian clients going back home, and just as you said, the longest I have heard from someone, I'm going for in 9 months. Then I had the 6 month, I had the 3 month, right? So kind of like, something can be done, but like what can be done? Like
Yeah.
paperwork alone, from our side, it is they're just paperwork, right? Never mind the planning or anything else. So yes, we see that, and it's not the best, but we try.
Mhm.
All right. So as we said again, like I don't mean to be repeating everything. So what we should be considering now is, timing your return, okay, aligning your goals, your offshore savings and investments, expert guidance, and the right structure in place. That's really those are the 5 points where we start with working on. So moving forward, what is the roadmap? So today, what we need to do is we need to begin with a financial planning review, awareness, and assessment. And for that, I'm really happy to tell you that we are offering now, actually, we have built on our website a financial planning portal. It's a secure portal where you can go in and create, you won't be able to go as far as creating the plan, but you can have everything that you need, and then we can tie it all at the end for you. And is this my screen or yours? Let's see. Annie?
Yeah, this is the roadmap
What is
one. The roadmap slide?
Yeah.
Yeah.
Can you put the video, or is it not running on your side? Oh, it's not because
Yes. Okay. No, but you know what I'll do? I think I'll just
send it to me.
just 1 second.
Sure.
Yeah, let me just stop this.
Yeah.
I think if you share now, then it should work.
Mhm.
Actually, it's Bassam, I think you need to reshare. Sorry, everyone, there's just a slight technical difficulty.
No problem.
So I'll jump in quickly here. So
Okay, please.
I'm just working with a client and who's leaving in about a year. And I'm so happy that we have a year to plan ahead. And what we're doing is as the first thing, we're coming up with tax estimates to really figure out, okay, how much is it going to cost you, right? And then we go from there to try to see, okay, how much tax you're going to pay. And if we can keep it to a reasonable level, we're not going to necessarily do any of the structures, right? So it's when you start looking at this and you have the timeline, it's important to start with, I think, just estimating your tax so you know what it might be. Because I do have some clients who want to move all around the world just to avoid paying tax, and it ends up being more costly for them because they have 3 homes and they're flying everywhere and stuff. So I think just you know identifying your exposure to the tax, I think that's really one of the key things in the whole plan, in the whole roadmap. So
Thank you, Wayne. And back to the planning part to help you start planning.
cash flow planning? Cash flow planning is the process of looking at your current financial situation and planning ahead for the future. So whether you're looking to retire early, take that once-in-a-lifetime holiday, help the children through education, or even purchase a house in the country, cash flow planning will help you make informed decisions. Think of it like a sat-nav in the car. Not only will it help you understand where you are and where you want to go, but it will highlight all possible options and help with any potential roadblocks along the way. Cash flow planning works on exactly the same principle. Gone are the days of complex spreadsheets full of numbers. Instead, you're met with powerful visual graphs which make absolute sense. And if you do want more detailed information, it's all there for you. A comprehensive report combines everything you're looking for and more, empowering you to make the right decision and ensure you do things you've always wanted.
And there you have it. So now we can start. Now we're helping you out to start planning baby steps, one step at a time, getting to the full-blown financial plan to help you whenever you're going back to whatever your next chapter may be it Canada, be it somewhere else. So this is this is your starting point. 1 to 3 years before you return, you should, address your residency, restructuring, identify exposure, structuring option that's on Wayne's side. Then you have the 5 to 10 years, and then upon return. So it's a lot of work. And by the way, on the bottom left corner here, you have a QR code that will take you directly to start your plan.
What is cash flow planning?
No, that's it. All right. So the next step, you need to go through a financial planning review. You need to know where you're at. We need to help you out. Excuse me. So take a look at where you're at. What is your current situation? What are your objectives? If you have a plan, are you still on track with the plan, or is it something that need modification, need tweaking, need adjustment? Something come to mind. I had a situation. I met a couple that was in Canada. I met a couple that they came back. I'm not sure where they were, but they had similar to a GIC. GIC is a guaranteed investment certificate, like fixed deposit, and they had good rate, and they locked it for I think 3 years because the rate was amazing. But after they locked it, they had a great opportunity to go back to Canada, and they came in and they showed me the certificate because they wanted to cash it, and because they want to put down payment on a house that they liked. Well, like of course, it's out of jurisdiction. There is not much I can do. They spoke to their institution or wherever they had the GIC invested with. Well, again, it's a locked-in investment, so it was locked in for 3 years, and they had to rent for the remainder of the period until the money became available. So they can't put a down payment on a house that already has gone up in value. So it was quite not sad. It was everything was good. But I mean, it was one of those situations like an aha moment that really need to plan before you go. If something happened that you move tomorrow is a different story. But if it's in the horizon, you need to work on it a bit earlier than later. Again, yeah, I need to identify your exposures and the structure. And as we said earlier, the difference between capital gain, between equity, your asset allocation in your portfolios, this need to be for the long term. That will be bulletproof while you're here, address your needs here or further when you go back home. And of course, everything has to align with your life goals. And then you have the confidence and the protection. Okay, so moving forward, because we don't want to take too much of the time, we received tremendous number of questions. I was telling Wayne earlier, I'm really, really, really happy that we put this together for everyone here today, because you were clear on your objectives. Your questions were quite to the point, and we segregated them. So some of you said, we're going back between 1 to 3 years, some saying 3 to 5 years, and some said 5 years longer or not sure. Okay, so I have the first question. This is moving out of Canada. So Wayne, would you like to take it from here?
Okay, so moving to KSA soon, I'd like to avoid paying double tax. First of all, there's no income tax in KSA, so that's good. I think Oman's the only place in the region that has, didn't they just introduce income tax? I think it was Oman, no?
Sorry?
I think Oman just introduced like a 5% income tax, no? I'm
I
not sure.
think they did, yeah.
Because otherwise there's no income tax yet. I mean, the UAE put in the corporate tax, so corporate tax is, and then next thing you know, it's income and what it is. So you wouldn't pay double tax, but the key is if you're going from Canada, you really want to make sure that you get rid of as many of your residential ties as possible. because there's no tax treaty with Saudi, right? So you really want to look at your residency in detail. And that really fits into the second question. If you don't have any residential ties to Canada, are you still taxed? The answer is no, as long as you've done a proper departure return. So when you leave Canada, you have to file a normal return, but you need to indicate that you're leaving. And then once you've done that, you're out of the Canadian tax system. But for people leaving Canada, whether you've already left or you're thinking of leaving, what we try to do is we try to do consultations before you leave, much like this, planning in advance always helps. And to the point, because Bassam actually sent me a client who didn't do any of that and ended up continuing to pay Canadian tax on their UAE income when they didn't need to, but because they didn't do any planning and they didn't do anything of that. So cutting your residential ties to make you a non-resident of Canada is crucial so that you're not taxed on your worldwide income. How to best manage offshore funds to ensure a smooth return. I know, Bassam, that's probably
Yeah. So yeah, I'll take that. So how to manage your offshore funds to ensure smooth return? Again, it all depends on the plan and your goals and objectives. However, this is not an advice, this is not an investment advice. As we mentioned, as we spoke just a little earlier, the type of assets you're holding generate return. And every return is taxed differently. Like as we discussed, the capital gain got 50% inclusion, interest 100%, dividend, so like it's a formula, but let's call it 85%, right? So this is something that will be reviewed. Number one, and never structure your portfolio to accommodate tax payable or tax situation, because when you do this, you may take on unnecessary risk, and the cost for taking risk that you're not ready for can be far overweigh your return. I mean, your tax bill, right? So this is something that you reach to a financial planner, make sure this is in line with what you're doing and your objectives, and we're here to support you. Okay, so repatriation planning consideration, that's a 3 to 5 years. I think this is Wayne and me, right?
Yeah. And I mean, from the, tax efficiency, I think we went over some of the options, and I think each situation is really specific, right? And it depends on level of wealth, and goals in the future and things like that. So, yeah, so that one's a bit hard because I think each situation, is really specific.
Mhm.
Yeah.
Okay. So, yeah, so what do we know? So we know about the repatriation planning. Yeah, again, like just as Wayne said, and you need to set up your goals, and you have a free app. Just go dive in and start plugging in your numbers, and things will come to clarity afterwards. So applicability towards both real estate as well as investment. Wayne?
Yeah, so there's an interesting one with real estate. People always ask me, should I sell my property, before I move back to Canada, in the UAE, or should I sell it, when I'm back in Canada? And I mean, that depends on so many factors. One is, do you want to keep it, and do you want to rent it out, or do you want to get rid of it? So each situation is specific. But I have a fun little plan that I do is I try to get people to sell the house 5 days after they move back, if they have a UAE house. And the reason is, so say it's worth 1 million dirhams, right? It's as if you bought it on the day you go back, right? And then if you sell it 5 days later, it's still going to be worth 1 million dirhams, right? It's not going to go anywhere. But then you can write off all your costs, like your realtor costs, your legal fees, and you kind of create a loss that you can use in the future. So, and this could be like 20, 30, $40,000 depending on the cost, right? So Again, timing about your real estate and thinking about this, both on the Canadian side and on the US side, can have big tax implications as well. So,
Okay, so Wayne, there's one. I want to go back to um, the question that moving to KSA soon. Um, some people are getting some advice, and help me out on this one, that they should liquidate everything, including, and I've seen them doing that, and it's a disaster. But I want to hear from you as well. To liquidate their RSPs, TFSAs, and everything before they leave Canada. Is that a strategic move?
no.
Thank you.
I honestly, I had a situation this year which just it kind of broke my heart as a tax planner.
Maybe we're talking about the same person.
Yeah, no, this
Maybe I
was
had
someone
something like that.
this was someone moving to the Philippines,
Okay, no.
and they had $600,000 in their RSP,
Oh,
right? And they withdrew it
no.
2 weeks. Yeah, I know. See, my reaction was the same. I was like,
Oh,
no, no, no. So they withdrew it like 2 weeks before they left because someone told them they had to liquidate their assets. And they ended up paying 53.5%. So they paid
yeah.
300,000 in tax. Had they done it 2 days after they left, there would have been a flat 25%
25%. Yeah.
withholding. So they cost themselves 150,000 by getting bad advice. And so, you know, these things really, really get to me, right? So you can
Mhm.
keep your RSP, you can keep your TFSA. The key thing is don't contribute as a non-resident because there could be
Mhm.
penalties and there's no benefits, but you're definitely fine to keep it there. Um, so, don't do that. So,
Mhm.
so
Yeah, I know. I know. Like we always used to say, don't listen to your brother, sister, your neighbor, your mechanic. Just
yeah,
talk to us. Thank you.
yeah.
All right. So moving forward, so for long term, so planning to move from Canada and return in 10 years. Okay, that question is not clear. Um, how to avoid probate and insight on trust for my family? That's a big question. Do you want to deal with this now or one off?
Quickly, I mean, probate, I'm going through this. I'm an executor in a estate. So probate, just making sure you have beneficiaries on as many assets as possible, right? Like RSPs, TFSAs, or life insurance to try to do that. Otherwise, there are things, and I'm not an expert in this area, where you could potentially set up different wills to hold different assets, I believe. Again, I'm not an expert on that. And so those are typically that. And the trust is just depends on your family situation, whether you know, y- you're not, your children are not going to be in Canada, or I mean, that's a whole different one. So,
Mhm. Thank you, Wayne. Um, I guess that will be it for us. And Annie, do you have any questions? There's David posted a
Uh,
question.
yeah, David posted a question and Santush answered it, but there was another sort of question on the end of that, Santush, if you don't mind checking. Oh, maybe you answered it. No, you answered it now. Yeah, did anyone else have any questions? You can drop them into the Q&A. If anyone has any questions, or if you put up your hand, I could also allow you to talk. I can turn on your microphone. So I don't see any questions coming in right now. Yeah, I don't see any questions coming in, but I'm sure people, oh, wait, there might be one here. Ali's asking use of discretionary foreign trust in planning. I can allow you, I just unmuted you, Ali, if you want to expand on that a little.
Hi, do you
yeah, I
hear me?
mean, yeah, sorry. Yeah, I mean, we'd
So,
want to we'd want to look in that the specific, like who the contributor is,
mm,
how long until they move to Canada, where the beneficiaries are, where the trustee is. Like it's a whole kind of complicated situation. Feel free to reach out to me if you want to send me more details. And then we could discuss it then if you want. But yeah, it's a complicated one.
Okay, I will. Where's your email address?
And
We're going to share it at the end. Yeah.
yeah.
Okay, thank you.
Okay, anyone else wanted to ask a question or anything? Okay, so yeah. Basim, did you want to kind of go over this slide?
Yeah, well, this will bring us to the end. I want to thank everyone for being here with us this evening. And as a thank you, you get a bonus for registering and being here with us. You get our guidebook From Expat to Homecoming Guide. You will receive this in your email, so please keep an eye out for your email tomorrow. And it's as exactly as it sounds. It's a guidebook From Expat to Homecoming Guide. It will cover everything we spoke about this evening and some more. And also, you will have the link that will take you directly to our secure portal for financial planning. And we hope that we can see we hear many successful stories. So take the next step, see the roadmap, practice and be proactive, and that's it. Annie?
Okay. Great. Thanks, Basim, Wayne, and Santosh very much. And thanks on behalf of everybody here. Thanks everyone for attending. And yeah, you'll get the email tomorrow. Wayne, did you want to drop your email address maybe into the question and answer panel or into the chat so everyone can have it? And then whoever wanted that. But Basim's going to send around emails and contact information tomorrow in the email.
Mhm.
Yeah, I'll just put it there quickly as well. And the one thing, so quickly on our end, is we work in a I put it, I guess it's in the answered part. Where am I? We work in a fixed price environment, so there's no surprises on pricing. We would typically have a 15-minute call in advance to get an idea of your situation, and then we provide you with our fixed pricing options. Again, no one likes surprises on pricing. We do tax consultations for people going, people coming back. We do tax returns. We have a whole specialized non-resident realty group for people that still own properties in Canada. I would say probably 90% of our business is, Canadian expats or people with international issues. So just want to add that in as a last thing. So.
Okay, thanks very much. I'm just gonna put the email there. Okay, thanks. Basim, did you want to say anything before we wrap up, or Santosh?
Thanks, everyone. Thanks, Santosh, for joining us today. Thank
Thank
you,
you.
Wayne.
Yeah.
Awesome. Thanks, everyone. Appreciate it.
Thank you.
But
Okay. Thanks, Annie.
yep, great.
Bye.
Nice to meet you. Bye.
Bye.